Hey everyone, and welcome to the Violet Vault. Today, we are pulling back the curtain on one of the biggest questions out there. Why do things cost what they do? It's all based on an invisible blueprint that sets the price for literally everything. And once you see it, you'll start to understand the world of money in a whole new way. Let's get into it.
So, have you ever just looked at a price tag and thought, how? How did they come up with that number? You know, why is a tiny, shiny rock worth more than the water we literally need to live? Or why can one house be worth $1 million while an identical one just a few towns over is a fraction of that? It can feel totally random, almost like none of it makes sense.
Well, the good news is it's not magic, and it's definitely not random. There's a system, a blueprint behind all of it. And today, we're going to break down the two key parts of that blueprint. First, a super powerful economic engine, and second, a hidden legal foundation that makes the whole shebang possible.
All right, so let's start with the engine. This is a concept you've probably heard a million times, maybe back in high school economics class, but stick with me because understanding it deeply is a true superpower. I'm talking about supply and demand.
Okay, first up, demand. Now, in the simplest terms, demand is about how much people want something. But, and this is the part a lot of people miss, it's also about whether they are actually able to buy it. You know, I might want a private jet, but since I don't have a spare $60 million lying around, I'm not actually part of the demand for one. It's the combination of wanting something and having the money to get it.
And then, of course, you've got the other side of the coin, supply. This one's even simpler. It's just how much of the thing is there to go around. How many iPhones did Apple make this quarter? How many apartments are actually for rent in your city right now? That's supply. Now, here's where it gets fun. These two forces, supply and demand, are in this constant tug of war. For example, if a new video game gets amazing reviews, a ton more people will want it at every price point, so demand shifts up. But if, say, people's incomes drop during a recession, demand for luxury goods will shift down. It's this constant push and pull that makes prices move every single day.
So here's the bottom line, the simple takeaway. When you have very little of something, low supply, and a whole lot of people want it, high demand, the price is going to skyrocket. Think of a rare collectible, a famous painting. But when there's a ton of something available and not many people want it, the price plummets. That right there is the engine that drives value.
But, and this is the part that most people never think about, that powerful engine can't just run in a vacuum. It needs a solid foundation to operate on. It needs a set of rules. And to find those rules, we're going to take a little detour to a surprising place, the history of law. I know, it might sound a little dry, but trust me, this is the secret sauce.
Just think about it for a second. How can you sell a house if you can't prove it's your house to sell? How can you buy a car if you're not sure the person selling it is the real owner? Before you can buy or sell anything, society has to have a crystal clear, agreed-upon way to prove ownership. Without that, you don't get a market, you just get chaos.
And if you want to see what that chaos looks like, get this. In early Australia, figuring out who owned what piece of land was a total mess. This quote actually describes how they'd sometimes measure property lines by having a guy just push a wheelbarrow and count how many times the wheel turned. I mean, can you even imagine trying to get a home loan when your property line depends on some dude's wheel counting skills? It's absurd.
So obviously, that crazy system couldn't last. It led to a total revolution in how we handle ownership, especially for land. We went from the old, messy system where you had to trace back every single historical document and pray you didn't miss something from 80 years ago that could void your claim, to a new system where the government just issues a certificate, a title, and that title guarantees you're the owner. Period. Talk about a game changer.
And that is the key takeaway here. These seemingly boring legal rules, they're not boring at all. They are the invisible bedrock that our entire modern economy is built on. If supply and demand is the engine of a train, then clear, reliable ownership laws are the tracks. Without the tracks, that engine just sits there spinning its wheels, going nowhere.
Okay, so we've got our two key pieces, the engine of supply and demand and the foundation of clear ownership rules. Now, let's put it all together and see how this blueprint plays out in one of the biggest and most important assets in any of our lives, real estate.
Real estate is just the perfect example of our blueprint in action. First, let's look at the engine. Supply, it's fundamentally limited, right? They're not making any more land. Demand, it's consistently high and often growing because people always need a place to live. So you've got low supply, high demand. And then you layer on that solid foundation, modern laws that give us a secure, guaranteed title of ownership. You put all that together, and you get an incredibly powerful formula for creating and storing value.
And if you want to know just how powerful that combination is, check out this number. The market for what's called tokenized real estate, which is basically a new digital way of proving ownership, is projected to be worth nearly $2 trillion by 2030. That's trillion with a T. You just don't see that kind of money flowing into an asset unless investors have total confidence in both the market forces and the underlying rules of the game.
So when we zoom out and look at the big picture, it all starts to click into place. The value of things, the prices we pay every day, they aren't just random. They're the predictable result of this really elegant, carefully constructed system.
This diagram here might look a little complex, but really, it's just a picture of the economy's heartbeat. It shows the constant flow of money, goods, and services between households, that's you and me, and the businesses we all buy from. And what's guiding this whole complicated dance? What's the invisible traffic cop for this whole system? It's the blueprint of value we've been breaking down.
So, at the end of the day, the price of everything from your morning coffee to a giant skyscraper is so much more than just a number. It's the final result of this dynamic interplay between raw human desire, the finite resources of our planet, and the clever, human-made rules that we all agree to play by.
And here's the best part. Once you see this blueprint, you can't unsee it. You'll start noticing it everywhere. So my challenge to you is this. The next time you look at a price tag, just pause for a second. Ask yourself, what's the blueprint here? What are the forces of supply and demand at play, and what are the ownership rules that make this transaction even possible? The answer is the key to understanding your financial world. Let me know in the comments, what's the first thing you're going to look at with these new eyes? I'd love to hear it.
Wow, that was something, right? But don't go anywhere, there's more coming, and it's gonna make you think in a whole new way. Quick reminder, if you like learning cool stuff without the fluff, subscribe now. You won't regret it.
Hey everyone, and welcome to the Violet Vault. You know, there's this concept in finance that sounds kind of complicated, maybe even a little scary, but it is single-handedly one of the biggest secrets to how people build massive wealth, especially in real estate. It's called leverage. And today, we're going to pull back the curtain and show you exactly how smart investors use a little bit of their own money to create a whole lot of wealth. So, how do they do it? Let's get into it. You've probably heard this famous quote before, right? Well, it's not just some philosophical idea from a guy in a toga. It is literally the blueprint for leverage. The idea is so simple, but so powerful. You use a small, manageable force to move something absolutely enormous. In the financial world, that small force, that's your own cash. And that huge object, that's a valuable asset, like a piece of real estate. And the secret sauce, the lever itself, is what insiders call OPM, other people's money. It's all about letting the bank do the heavy lifting for you. All right, so let's get down to brass tacks. How does this ancient idea of a lever actually work in our modern financial system? What does using debt to control assets actually look like for you and your money? Okay, that sounds super formal, right? Like something out of a textbook. Let me translate. All it really means is you're using a little bit of your own cash, plus a loan, to buy something big. You're making a bet that the money you make from that big thing, either from its value going up or from income it generates, is going to be way more than what you have to pay in interest on the loan. And when that bet pays off, oh man, the results can be absolutely life-changing. And really, when we talk about leverage, the perfect, most common example is the good old-fashioned mortgage. This is what makes real estate so different from, say, buying stocks. If you want to buy $100,000 worth of stock, guess what? You need $100,000 in cash. But with a property, a mortgage lets you control that entire $100,000 asset with maybe only 20% down, sometimes even less. The bank is cool with putting up the other 80% because, hey, if something goes wrong, they have the house as security. Now lean in for this part, because this is where the real magic happens. This is the concept that once you get it, it will completely change how you look at investing. Using leverage doesn't just give you a little boost. It's like putting your returns on steroids. It completely rewrites the rules of how you calculate profit. Let's make this super clear with an example. Imagine two investors. We'll call them Investor A and Investor B. They both buy identical $100,000 houses. Investor A is cautious, pays all cash, $100,000 out of their pocket. Investor B is savvy and uses leverage. They put down just $20,000. Now, let's say the market does well and both houses go up in value by 10%. That's a $10,000 gain for each of them. For Investor A, a $10,000 gain on a $100,000 investment is, you guessed it,
a 10% return. Not bad. But for investor B, that same $10,000 gain is measured against their personal investment of just $20,000. The difference is just, wow, a 50% return. Isn't that incredible? That is the raw power of leverage. Your profit isn't calculated on the total value of the house, it's calculated on the money that actually came out of your bank account. You get 100% of the upside from the whole property appreciating, even though you only paid for a small slice of it. That is a total game changer. And believe it or not, it gets even better. Magnifying your returns is just the beginning. The interest you pay on your mortgage, that's usually a tax deduction, which can save you a ton of money. Plus, instead of tying up all your cash in one property, you can now buy 5 properties with that same 100 grand. And if you're renting them out, the rental income can cover your mortgage payment and maybe even put extra cash in your pocket. And my personal favorite part, your tenants are literally paying down your loan for you, building your wealth month after month. How amazing is that? Okay, we've talked about all the exciting, amazing parts, but now we have to have a real, honest conversation, because this is the part you absolutely cannot afford to ignore. That same mathematical magic that supercharges your gains is a double-edged sword, and it can cut just as deeply on the way down. Just like leverage blows up your gains, it does the exact same thing to your losses. Let's go back to our 2 investors. What if the market goes down by 10%? That's a $10,000 loss. For the all-cash investor, that's a 10% loss. It stinks, but it's manageable. But for a leveraged investor, losing $10,000 on a $20,000 investment, well, do the math. That's a whopping 50% loss of their own money. Ouch. This is the risk you have to respect. So you might be wondering, how do banks and professional investors protect themselves from this? Well, they use a key metric that sounds complicated, but it's really not. It's called the Debt Service Coverage Ratio, or DSCR. All it is a simple stress test. It asks, does this property's income cover all of its debt payments? Lenders want to see a nice cushion, so they usually look for a DSCR of 1.25 or higher. That means the property is bringing in 25% more cash than it needs to pay its bills. But if that number drops below 1, say to 0.95, that's a huge red flag. That's when the financial bleeding starts. It means the property is only making enough money to cover 95% of its own bills. And that other 5%? Guess where that comes from? Yep, it comes out of your pocket every single month. That's how investors get into deep trouble, feeding a property that was supposed to be feeding them. Now, I know that sounds scary, and after hearing that, you might be tempted to say, you know what? I'm just going to avoid debt altogether. But hold on, because that's not the lesson here. The goal isn't to be afraid of debt. The goal is to become the master of it. The real skill is learning how to use it powerfully while controlling your risk. So how do you actually do that? Well, you build a system. It means you don't put all your eggs in one basket, you diversify. It means you set alarm points, think of them like the check engine light for your investments, that tell you when it's time to pay close attention. And maybe most importantly, you have to be obsessed with the data. You're constantly watching the vital signs of your investments, things like vacancy rates and local market trends, so you can see a small problem and fix it before it becomes a disaster. And all of this brings us to what I think is the most important mindset shift you can make. For most of our lives, we're taught to think of debt as a burden, as something bad. But I want you to start seeing it differently. I want you to see debt as a tool. And like any powerful tool, whether it's a chainsaw or a surgeon's scalpel, it can do incredible things in the right hands, but you have to use it with skill, respect, and knowledge. And you know, this tool has been perfected over a long, long time. The stable, predictable mortgage that we know today didn't just pop up overnight. It was actually forged in the fire of the Great Depression in the 1930s, after older, much riskier types of loans completely failed and wrecked people's lives. The modern mortgage was specifically designed to be a stable, reliable tool for building wealth over the long haul. So, it all comes down to this. The skill of a truly successful investor isn't in avoiding debt, it's in controlling it. You know, savvy investors don't ask, can I afford to pay cash for this? That's the wrong question. They ask, is paying cash the smartest and most efficient use of my capital? And more often than not, the answer is no. Keeping their cash free for other opportunities while using the bank's money to build their portfolio is the strategic move that leads to incredible growth. So I want to leave you with this question to really think about for yourself. In your financial life right now, is your debt a liability that's weighing you down, or could it be your most powerful asset in disguise?
When you treat it with knowledge, with a system, with discipline, the answer to that question can mean the difference between slowly plodding along and truly building a financial legacy for yourself and your family. Let me know in the comments, what's the first step you're going to take after watching this? Because in the end, it's not just about how much money you have, it's about how smart you are with it.
Wow, that was something, right? But don't go anywhere, there's more coming, and it's gonna make you think in a whole new way. Quick reminder, if you like learning cool stuff without the fluff, subscribe now. You won't regret it.
Have you ever felt like you're stuck on a financial hamster wheel? You work hard, you get that raise, but somehow you just can't seem to get ahead. Well, what if I told you it's not about how much you earn? It turns out the wealthy are playing a completely different game with their money, one with a whole different set of rules. And their number one rule? It's not just about making money, it's about keeping it. So today, we're gonna break down those rules. And this quote right here, it just hits the nail on the head. We spend our whole lives focused on part one, earning it. We go to school, we get a job, we climb the ladder, all to make more money. But that's only half the battle. The real secret, the part that separates the people who build lasting wealth from everyone else, is figuring out how to stop your hard-earned cash from just vanishing. You know that feeling, right? You get to the end of the month, you look at your bank account, and you're just like, wait, where did it all go? It feels like you're pouring water into a bucket full of holes, and it's so frustrating. But here's a wild thought. What if those holes aren't there by accident? What if they're actually a built-in feature of the financial system most of us are taught to use? And that leads us straight into what we can call the middle-class money trap. This is the paradox where working harder and earning more doesn't actually make you wealthier. You're just running faster and faster to stay in the exact same place. It's a frustrating cycle, so let's pull back the curtain and see exactly what's going on here. So, where are the biggest holes in that bucket? It's probably not where you think. We're always told to, cut back on lattes, but the two biggest money drains for most people are interest and taxes. Just think about that for a second. Every dollar you pay on a credit card or a car loan, and every dollar taken out of your paycheck for taxes is money that's gone. It's flowing right out of your pocket and into someone else's. And when you see it like this, it's wow. It really puts it into perspective, doesn't it? For so many people, the chunk of money going to taxes and interest is just massive compared to what's left for, actually living your life and building your future. This isn't a small leak we're talking about. It's like a fire hose pointed away from your bank account. And if you want to see the results of that money trap, here it is. This is a genuinely shocking statistic. A few years back, the average 50-year-old in America had a net worth of zero. Zilch. Nada. After decades of working, the average person had saved nothing. If that doesn't scream that the financial playbook we're all given is fundamentally broken, I don't know what does. So, if the game most people are playing is rigged against them, how do you win? Well, the answer is simple. You don't. You stop playing their game. You learn the rules to a completely different one, and that is exactly what the wealthy have done. Their entire financial strategy is built on a totally different foundation. Okay, lean in for this one because this slide is the whole ball game. This is the big aha moment. For most people, as an employee, the order is you earn money, the government immediately takes its cut in taxes, and then you try to live off whatever is left. But for a business owner, the order is flipped on its head. They earn money, they get to spend that money on things to grow their business, and then they pay taxes on what's left over at the very end. Just reordering those steps, it changes everything. It's a total game changer. Now, when we hear the word loopholes, it kind of sounds a little sneaky, right? Like you're cheating the system. But you have to get that idea out of your head. These aren't secrets or tricks. They are written into the tax code on purpose by the government. Think of them like coupons or rewards. The government offers these incentives to encourage people to do things they want, like start businesses that create jobs or invest in real estate to provide housing. All right, so to start using these government coupons, we first have to understand a super important concept. Not all money is treated equally by the tax man. The way you make your money has a huge impact on how much of it you actually get to keep. First up is earned income. This is the one we all know. It's your paycheck, your salary, your wages, basically any money you get for trading your time and effort. It's the most common way to make money and, well, it also gets hit with the highest tax rates. The government taxes this income the most. Okay, next we've got portfolio income. Now we're getting warmer. This is money that your money makes for you. So think about profits from selling stocks or dividends you get paid just for owning a piece of a company. This is a step in the right direction because portfolio income gets taxed at a much friendlier, lower rate. And finally, we have the one you've probably heard about, passive income. This is the top tier. This is money that your assets, like a rental property or a business you own, earn for you. And this is where the real magic happens, because when you play your cards right and use those government incentives we talked about, this income can have the lowest tax rate of all. Sometimes, you can even legally pay zero tax on it. So let's just lay it all out nice and simple. Earned income, where you work for it, gets the highest tax. Portfolio income, where your money works for you, gets a lower tax. And passive income, where your assets do the heavy lifting, gets the lowest tax. The entire strategy of the wealthy is to convert their income from that top row, earned income, down to the bottom 2 rows. That's the game. Okay, so that's the theory, but how do you actually do it? How do you make that shift? Well, for most regular people, the 2 best on-ramps to this new way of thinking are starting a business and investing in real estate. These are the 2 main arenas where all these powerful tax rules come into play. Let's just take real estate for a second. Why in the world would the government give landlords so many tax breaks? It's really simple when you think about it. The government needs its citizens to have a place to live, right? But they don't want to build and manage all that housing themselves. So they offered tax incentives as a way of saying, hey, if you help us out by providing housing, we'll help you out at tax time. It's a partnership.
The same exact idea applies to starting a business, even a tiny side hustle from your kitchen table. The moment you do, a whole new world of deductions opens up. All of a sudden, things you were already paying for, part of your rent for a home office, your cell phone, your internet, even your car, can be turned from personal expenses paid with after-tax dollars into legitimate business expenses paid with pre-tax dollars. And every single time you do that, you lower your taxable income. So I know this all sounds pretty fantastic, almost too good to be true. And before you get too carried away and rush out to buy a rental property, we gotta pause for a quick reality check. Because the dream of passive income is beautiful, but the reality of getting there can be a lot of very active work. On one hand, you have the financial side, which is amazing. The source material points out that thanks to things like depreciation, you can end up with more tax deductions than you actually have cash coming in. So you could be collecting rent checks every month, putting real money in your pocket, while on your tax return, it actually looks like you lost money. It's a powerful legal advantage. But then there's the other side of it. And this quote from a real-life investor on Reddit is just the perfect dose of cold water. They're not mincing words. Real estate is not passive. Things break, tenants have emergencies, and if your plan is to just sit back and watch the rent checks roll in without doing anything, well, you're not an investor, you're the problem landlord that everybody complains about. And that really is the consensus you'll find from people who are actually doing it. They'll tell you that the dream of passive income is just that, a dream. The reality, especially at the beginning, is that managing a business or real estate is often like having a second job. It's rewarding, for sure, but it takes work. It takes your time and your focus. Okay, so we've talked about the trap that keeps most people stuck. We've talked about the different game the wealthy play, and we've had a little dose of reality. So with all that on the table, what's the real, actual first step you should take? Where do you begin this journey? The answer might not be what you expect. The author of our source material, Diane Kennedy, tells this brilliant little story about crabs in a bucket. If you put one crab in a bucket, it'll climb right out, no problem. But if you put a bunch of crabs in there together, none of them will ever escape. You know why? Because the second one crab starts making its way to the top, the others will literally pull it back down. And her point is powerful. The first step to changing your financial life has nothing to do with spreadsheets or bank accounts. It has to do with the people you surround yourself with. You need a team, mentors, friends, advisors who will give you a boost up, not pull you back into the bucket. So as we wrap this up, I want to leave you with a question. Not what did you learn, but what are you going to do? It doesn't have to be some giant leap. Maybe it's just reading one chapter of a book about this stuff. Maybe it's having a conversation with one person who thinks this way. Whatever it is, I want you to really think about it. What's the first small step you're going to take to start writing a new financial story for yourself? Let me know in the comments below. I'd love to hear it.
Thank you for spending time with us here at the Violet Vault. Don't forget to like, subscribe, and drop your thoughts in the comments below. I'd love to hear from you. Until next time, stay focused and keep growing.